Hey, it's Mark Yagi again, coming to you not live, but from a transatlantic cruise that I'm on. I've been on this thing for about 10 days and heading to Europe from Florida. Just finished the islands of the Azores. It was really fun, beautiful place. Anyway, so I thought I'd make a video and just tell you the next four golden rules of the cash flow machine, because we have certain rules because it is a system. And so you need to have those rules kind of in place before you get to investing your hard-earned money. So number one of the next iteration of the golden rules of the cash flow machine is you've got to keep an eye on tax issues. Now, one easy way to do this is to have it in a tax-deferred account, like an IRA, SEP IRA, Roth IRA. That's obviously easy. Then any gains and losses don't really matter because you don't pay taxes until you take it out, or maybe you've already paid the taxes into it if it's a Roth. So that's the easiest way. But the second one is, there's a lot of activity in, at least the way we do the cash flow machine. Most of my clients and my customers and students do weeklies. And so weeklies are basically, you are buying the stock and you're holding the stock and then you sell against it every week. Now, you're either creating income every week, and most of the time you are because you're creating juice. But if it goes up, you have a negative position on that option, right? Because you buy low and sell high in reverse. And if you sell at, let's say you get $5 for the option and it goes up to 10, well, you're going to have to spend $5 to buy it back. So that's a loss, right? According to the IRS. It's not really a loss because you're getting the juice, but from a tax perspective, it's a loss. That's cool because if you have a bunch of losses, then you don't have to pay tax on a taxable account, right? If you have more losses than gains. However, your base position goes up too, right? And so if you sell that, basically you can sell that and harvest the loss against the gains, essentially what you can do. So there's a lot more to taxes. There's a 475F election. There's a mark-to-market election. There's doing it in a business. There's all kinds of stuff, and I have videos on that somewhere around this channel. But tax issues are something to keep an eye on. I don't invest everything around tax issues, right? Tax issues are important, but I don't want to invest my whole strategy and worry about taxes. I kind of do it toward the end of the year if I'm in a taxable account or a non-mark-to-market account. And then I kind of take care of it. If I'm in a profit position and I've got a bunch of losses, I'll use up the profit, or vice versa. If I've got a bunch of profit and I have some unharvested losses to take care of, then I'll go ahead and offset those so I don't have to pay tax. The worst thing to do is pay tax on something that you could avoid if you just realized the position and rolled it to the next month. You have to go 31 days out, or rolled it to a totally different issue altogether. So that's number one, is keep an eye on tax issues. Another one is to consider deeper and further out calls. So for increased income and downside protection, especially in a market that's not uptrending, what you can do is you can make sure that if the market goes down, you can get dollar for dollar gains on your short position. So you can go deeper if the stock is in kind of a decline or a little bit of a downtrend. And then you won't lose money really because you're protecting your downside using the deeper in the money call. You can also go farther out and pick up a little more juice if you go farther out. So consider those deeper and farther out calls to protect yourself. Don't get caught up in the theory, right? This is not perfection. This is probabilities. So another thing that a lot of people do is they get caught up in the theory. They start worrying about deltas and what's my theta and what's my, theoretical option price. What's the Black-Scholes model say? The bottom line is all that stuff just takes your focus away from taking the juice, right? That's what we want to do, is we want to squeeze the juice 1% to 2% a week, 2% to 4% a month, whatever it is for you. Don't take your eye off the ball by starting to worry about theory and delta crossovers and all these other things that we can get bogged down in, but keep your eye on the big picture. Keep your eye on the long term too. And don't trade synthetics until you're mentally ready. So synthetics are deep in the money calls that replace the option base, right? They replace the stock base, I should say. And so deep in the money calls are great, and they allow you to leverage maybe 2, 3, 4x by adding just a little bit extra risk to your account. However, there's a lot of hair around them, right? There's deltas. There's things you don't have to worry about when you're just in stocks that now you have to worry about when you're in synthetics. So don't trade synthetics until you're ready. By the way, if you're going to be trading a little bit bigger using synthetics, you've got to have bigger muscles. You have to be able to handle the ups and downs because things move a lot more. And, if you have a stock that moves against you and you all of a sudden had built up a 200 contract position or a 400 contract position, 400 contracts is 40,000 shares. That stock moves down $1. That's a $40,000 loss. Can you handle that in a day, right? Can you handle that in a week? Don't be too excited about getting into synthetics, because the downside cuts both ways too. It just does give you leverage in a nice flat or uptrending stock that you want to be able to sell against and pick up your juice. But you've got to be ready for it. So I always say you're not going to go sit down at the bench press and bench your 350 pounds. You're going to have to start with 150, work up to 200, then 250, then 300. And that's the way it does. So you've got to build your muscle, and don't be too quick to get into synthetics. So that's it. Those are the four tips for today of the golden rules of the cash flow machine. Keep an eye on tax issues, consider deeper and further out calls, don't get caught up in theory, and then don't trade synthetics until you're mentally ready. So that's it. Until next time, I'll see you on the next video. Take care. Hi, Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. Now, best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there.